The British economy unexpectedly shrank in October. Welcome to Market Insight. I'm Ramzan Karmali. Well, UK GDP contracted 0.1%. A Reuters poll had actually predicted expansion. The news will come as a blow to Finance Minister Rachel Reeves and her mission to boost growth. This data suggests that the economy declined even before Reeves's £40 billion tax-raising budget on October 30th. So does this mean things will get worse for the UK economy? Well, to help answer that and more, I'm joined by Josh Passmore, Investment Director at Artemis. Josh, thanks so much for joining us. So what's your reaction to this contraction? I mean, it also marks the first back-to-back monthly declines in over 4 years. But should we be cautious about reading too much into the numbers, as monthly data has a reputation to be fairly volatile, no?
Hi, Ramzan. Yeah, I'd agree. Month-to-month economic data can be very volatile, as you say. But I think we need to try and maybe think about some of the longer-term trends here. The economy has definitely slowed in the last few months. Growth was much stronger towards the start of the year. And actually, if we look back to the first half of the year, the UK was the fastest growing economy in the G7. However, I think I would maybe make the point more generally that growth in the UK and sort of the macroeconomic story in the UK has been better than the general narrative would have you believe over the last 2 to 3 years. Our interactions with companies and indeed the data would suggest that the consumer's in pretty good health. There's also sort of in the region of £300 billion worth of excess savings on the sidelines in consumers' pockets, and we've actually got positive real wage growth as well. So I would agree the economy is definitely slowing, but I think it's important to make the point that growth hasn't necessarily been as bad as you might have thought over the last few years. Maybe one more point to make is that for us as investors, the UK stock market and the UK economy are quite different beasts. The UK is the world's most global stock market with 75% of revenues derived from overseas. So when we're thinking about the success and failure of some companies in the UK, they're not necessarily too closely related to the economy.
Sure, but what about things getting worse potentially? I mentioned in the introduction Rachel Reeves's October budget. A lot of plans to raise taxes there. Could that make things a lot worse?
Yes, I think in the short term, things could definitely get worse. Obviously, the burden on business from the budget, so increase in national insurance contributions, etc., was probably slightly more than we would have expected or wanted. But the government's entire manifesto really was to grow the economy. So we would hope that some more sort of supply side reforms that were maybe originally lacking in the budget in October are announced over the next few months. We've heard some positive noises, I think, so far, but we sort of wait for concrete action there.
Now, next week, the Bank of England meet. Could today's data perhaps make them consider cutting rates again, or is it just a bit too close to the date?
It's a fair question. I think I would probably say it's a bit too close to the date. Market's not expecting a cut next week. The market expects 3 cuts next year, and 4 cuts is what the bank themselves has forecast. I think we would make a couple of points there. I think firstly that sort of the market has been a pretty poor predictor of future interest rate moves over the last 2 or 3 years across this very aggressive hiking cycle. And that also I think central banks probably have reason to be cautious as opposed to aggressive with interest rate cuts, primarily because unemployment's still pretty low across a lot of Western economies. Wage growth is quite strong and government balance sheets are very indebted. So we would probably say the risk is that rates are not cut as quickly as the market or investors might like.
But isn't there a problem here for the Bank of England? We had the ECB cut yesterday. We'll likely see the Fed cut as well next week. Does the bank risk sort of being left behind here?
I think it's a fair question, and don't fight the Fed is a very popular phrase for a reason. I think what we would say more generally, though, going back to that earlier point, we don't really see the path for interest rates to fall particularly quickly anywhere, just given the strength of the global economy. Now, you never know what might be around the corner. If we were to go into recession, that would be very different. But we're not necessarily sure there's too much wiggle room for aggressive interest rate cuts over the short term.
Josh Passmore from Artemis, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.